Good afternoon, and thank you for joining us today for an update on the newly finalized microcaptive regulations and their impact on the automotive F&I reinsurance industry. My name is Tara Thomas, and today I'm joined by my colleague Robert Davis and our friend and trusted advisor Andy Weil. Today we're going to keep things relatively high level, meaning we're not going to cover every possible nuance that exists in the regulations. Andy's going to start us off with a history of the microcaptive regulations, an overview of how do we get here and where are we headed now that we have finalized regulations finally. Robert will then lead us through an overview of the new regulations, and we'll wrap up with the discussion on the filing requirements for those transactions that will be identified as a listed transaction or a transaction of interest. There will be time for questions at the end of the presentation, so please use that chat box on the side to note any questions you have during the presentation, and we'll try to get to as many of those as we can afterwards. So without further ado, I'll go ahead and segue over to Andy to get us started.
So in order for us to be able to appreciate what the new regulations establish, it's good to have the context and how we got to this place. Back in the good old days, there was just limited IRS interest in this whole area of F&I, and there would be a few transactions. There was one big case, the Wright case, but essentially it was a low attention area until the 2002, when some audits started as a test case, and there was the issuance of Notice 2002-70, which turned reinsurance arrangements into listed transactions, an unfavorable presumed abusive transaction part of the code with various requirements. That investigation continued in the test cases. Those resulted in favorable technical advice memos, TAMs, in 2004. And as a result of that, Notice 2002-70 was obsoleted. The IRS said there wasn't as much abuse in this area as we thought, and they turned away from F&I risk to and focused their attention on enterprise risk issues. In other words, they were not that interested in the unrelated third-party risk aspects of the captive industry, but more the risks that they thought were disguised forms of self-insurance or otherwise a misuse of the form. The next big development came in with Notice 2016-66, but the background of that is relevant. The service had been targeting certain really problematic arrangements, and they felt that there were particular problems with coverages that really weren't legitimate. There were poor practices, the claims weren't paid, and financial aspects of it where the money was essentially coming in and then going right back out. So that led to several decisions that were favorable to the IRS in challenging these arrangements. But at the time of Notice 2016-66, when those of us in the industry who saw this were concerned, it was not completely clear whether they really wanted to go after F&I, but the way it was phrased left us concerned that there was certainly a way in which it could be seen, especially for certain products like GAP, where there was risk that the dealer would be on for a moment. We made efforts to get that looked at and clarified in favor of the industry. They were unsuccessful at the time. They wanted to keep the scope of this notice broad. Things also really took off in 2017 with the Abrahami case, which was an enterprise risk case with some very unfavorable facts. It involved things like terrorism, anti-terrorism insurance for jewelry stores in Phoenix, and various other steps that were of concern to the IRS. And they followed that up with several other bad fact cases. These cases, though, were all in the area of enterprise risk. They were not F&I. At the same time, there was a challenge to Notice 2016-66 by a company called CIC Services, and they were claiming that the notice was invalid and that it had not been following administrative procedures. At the time, I looked at that and I said, there's no way that that case is going to go anywhere. I was not correct. At the same time, the IRS was using its authority under 2016-66 to launch projects to examine abusive arrangements. And while it was not targeted at F&I, it had an impact on our industry. Most of us professionals thought it was advisable to file protective disclosures under Form 8886 in order to be sure that there wasn't any compliance issue. These, as probably everybody who's listening you know, were troublesome, extra paperwork, extra time and energy, extra expense. There were occasional audits of F&I during this period. However, they led usually to successful outcomes, no change, and it depended upon the kind of agent you got. Once it was explained to them, they would understand that there was nothing to be found here, but those were burdensome and expensive audits. As I said, we kept on pursuing this idea of get F&I out of it, but the IRS continued to want to cast the net widely. And that the way in which we were able to get the success was to show we are not like those fact cases. And you got to focus on the fact that this is unrelated third-party risk. We have paid the claims. There's clear business purpose here. At that time, it did not seem like our efforts were having much success. And that brings us to, I believe, the first polling question.
Great. So we'll go ahead and jump into the first polling question. This hopefully is an easy one for everybody. How are you involved with automotive F&I reinsurance? You own a reinsurance company, you are a reinsurance service provider, you're a CPA who works with dealerships and or reinsurance clients, or maybe you're just here because you wanted CPE. No shame in that. It was something that we all need. But certainly make sure that if you are looking for CPE from today's webinar, make sure that you get this answered. And thank you, Andy, for the background and history on these regulations. I'd be curious to know, from your perspective, was the timing what you thought it would be? Did the finalized regs come later or sooner than you anticipated?
They came later. When we found that there was a notice that the proposed regs came out in 2023. There were comments taken, and this is a good opportunity for me to say, at this point, the professional community in F&I really pulled together. We worked in a collaborative fashion. We got comment letters out to the IRS. They were well composed. They made cogent arguments. And as Robert's going to discuss in the next segment, you will see that those efforts paid off. I do think that one of the reasons I thought that they were just going to rubber stamp the proposed regulations. That is not what happened. And they paid some serious attention to what had been submitted. And some good things came out of that.
Wonderful. Well, thank you again for covering that section of the presentation. We will go ahead and shift into what I would describe as really the meat of the presentation. Robert Davis is going to cover an overview of the finalized microcaptive regulations, what changed from the proposed regulations, and some flowcharts so that you can determine how your reinsurance companies will fall into one of these buckets. So Robert, I'll kick it over to you.
Okay, thanks, Tara. I'm assuming everybody can hear me just fine. And so, at any rate, I want to add my welcome to everyone else today for joining. I think we've got a pretty good crowd here today. And, let's start with an overview of these finalized regulations. They really put the final paintbrush on the efforts of the IRS, to move from the original research project that was conducted out of the enactment of Revenue Procedure 2016-66 that declared a set of transactions as a transaction of interest and moved to the next step. And so the next step, and they said this all along, the next step was going to be to decide what was going to be a listed transaction or what was going to be, as I like to call it, a never mind transaction. Much in the way we in 2002 and 2004, this was a bit of a Groundhog Day for quite a number of people, and reminiscent of, I'm going to date myself here, Roseanne Rosanna Dana here from the Saturday Night Live skits. where she would go off on the tangent and then find out that she is just talking about something, and then she'd end up and go, never mind. Well, that's exactly where we hope we end up today. We're going to examine the never mind category in closer detail here. But before we do, there really are some notable changes that we're going to cover today. The administrative obligor only programs, continue to apparently fall outside the scope of the final regulations. The infamous commission test that was in the proposed regulations that, well, they appeared from galaxies unknown in the proposed regs, was transported back from whence it came, much like me using that particular phrase that originated in the 13th century. And then finally, the issue with gap contracts and the transitory time period where the dealership was the insured in that time period between that you finished the deal, but the contract hadn't been bought yet by the financing source. That's no longer an issue. The loss ratios that form the floor for reporting as a transaction of interest or listed transaction have been lowered. And that's going to take some of the companies out of the spotlight. And then finally, the listed transaction stigma, okay, and that reporting now require a conjunctive test that was not available prior to the regulations. So all these things really were things that we sort of smiled upon. All right, so, we've got a few terms. There's many of them here. A newly issued set of regulations just wouldn't be complete, without a pile of definitions, and these regulations certainly did not disappoint. So we're going to hit a couple of them here. And so the first one on the slide, as you can see, is seller. Wait for it. It's the guy that sells something. It's a real shocker here. But nonetheless, seriously, this is a seller of products and services that can be insured or reinsured, and 95% of the seller sales are to unrelated customers. We've got a little 5% buffer in there for our friends and family, if you will, family in particular, that we can turn around and sell mom a VSC if we want to. All right, the related to captive requirement, so look, the IRS has long realized that without rules that include or in your family members and commonly owned entities into the rules and constraints imposed by the code, if we didn't have those that sort of piled those up together, the taxpayers would use family members and use commonly owned structures to get around what the IRS was actually trying to accomplish. These related party rules are throughout the code in numerous places, and they appear in very complex structures, like some of the structures we see related to these companies. And so it really, even harkening back to the 2016-66 days, getting through these rules was somewhat of an Ancestry.com nightmare, if you will. But we sort of got through it, we got used to it. And then the sections that were embodied into the regs of who was related was expanded into the 2700 code sections in the proposed regs, and that was held in these final regs, basically for the day, where we're talking about 20% of the assets, vote, or value, of the captive owned directly or via these related party rules, by an insured seller or owner. Finally, we touch upon the financing factor. Okay, taxpayers have been dealing with this since 2016-66, and it has to do with the IRS frowning on people taking loans out rather than distributions. Okay, and so now the final regs turn around and they have up to a 5 tax period look back, okay, on loans being taken out, or it also includes guarantees. So if you turned around and guaranteed something with the assets, the strength of the reinsurance company, if you will, that's also embodied in the financing factor. Okay, and then they test this financing factor against, or the amount of these loans that are outstanding, against the inception to date after tax earnings, investment earnings of the insurance or reinsurance company. And that's going to be one of those things that you're going to pass or fail that will come in to the tests that occur inside the regulations. But let's go ahead and get into the meat of the regs a little bit. And we've done this with a series of charts, or what we like to call testing loops. Okay, so you may find these helpful. I hope that you do. The opening salvo here, if you will, is the captive testing loop. Now, it's not official. That's what we called it. Okay, I like to call it the first escape hatch. Okay, this is an or test as opposed to an and test. This is an or test. So what are we looking at here to see if we can escape? Okay, first, perhaps the company we're looking at did not elect 831B. Okay, well, if you're not under 831B, you escaped. Okay, now, does the captive insure or reinsure purely administrative obligor product? And think about this, where the dealer is not an insured, okay, or a party to the contract. All right, that's an easy way to begin thinking about the administrative obligor test here. If you're all admin obligor, the way I explained it, once again, there's an escape. Okay. Finally, that 20% of the asset's voter value, taking into account, your attribution, your related party rules, being owned by the insured, a seller, an owner, that type thing. If you don't meet the 20% test, again, you have fallen outside the scope of the regulations, and you've walked through the first escape hatch, what we call the captive testing loop. Now, look, could somebody come up with some off-the-wall example, since these regs are brand new, and I'm going to exercise my own escape hatch, and say something like, that's beyond the scope of this presentation, but nonetheless, there will be things that come up when you put pencil to paper and begin to dig into the meat of this. Okay, but look, if you didn't escape, you're not done yet, and we can go to the next slide, the next set of tests. Okay, so now we're in what I like to call the seller's captive testing loop. All right, so now I think this is the most highly anticipated portion of these regulations for our audience today in terms of people that deal the vast majority with third-party risk rather than dealership risk. Okay, so this is what the third-party risk folks have been salivating over and waiting on in the final regs. And it constitutes what I like to call the second escape hatch. And to pass this test and escape, it's an and test. Okay, so to pass this test, we got to do a few things. Number one, we got to be related to the seller. Okay, seller's related to the captive. All right. If we were not related, we escaped on the last slide. But so now we're related here. And so we've got to meet that requirement. Secondly, and very importantly, okay, we don't want to be insuring or reinsuring any enterprise risk. Enterprise risk is dealership risk in many cases for our audience today. All right. And we think about garage liability, workman's comp, or perhaps that little policy that you put together to insure the dealership against F&I chargebacks. Well, that's dealership risk. In order to use this escape hatch, I can't have any of that in the captive. Okay, now, the next thing, I want to treat all the products that are in the captive as insurance. Now, these regulations don't define insurance. It has not been defined in the code. It is defined in the courts. Okay, so these regulations didn't change that. They talk about treating the items in the risk portfolio as insurance. We could talk and debate about prepaid maintenance and limited warranties and whether they're really insurance or not. That's not the point of why we're here today. But we do have some administrators that will take some of these products and not treat them as insurance products inside the tax returns. And when that happens, this testing loop, this escape hatch, has evaporated. Finally, 95% of the risk, the portfolio risk, is to unrelated customers. Well, that's people like, myself, that I walk in and I buy a VSC and I'm not related in any way to the dealership or the reinsurance company. Okay, so nonetheless, what happens here? If you pass the test, you don't have a filing requirement and everybody's very happy. If you didn't escape, you're not done yet. Okay, so we're going to head off to the next slide here. And now we're to the dreaded listed transaction testing loop. And if you're here, now it's time to be a little bit worried. Okay, so look, before I get into it, as a side note, if you read the structure of the regulations, the seller's captive stuff is inside the portion about the listed transactions. Okay, we strip it out and put it on top because if you pass the seller's captive testing loop, then we're done and you're not wasting a lot of time dealing with whether you're a listed transaction or not because you've already escaped. Okay, but let's look at this test. To fail this test, you must meet various requirements. This is an and test to fail, and it is not an escape from the reporting requirements. All right, so what do we got here? Is your captive existed, the slide says 10 years. I'm going to say 10 tax periods because short periods count as a year in the regs. Okay. Have I failed the financing factor? Okay, I have to fail the financing factor having to do with loans or guarantees or those type things. All right, I have to be in existence for 10 tax periods and, in a very favorable move, have a loss ratio, okay, from the last 10 tax periods of less than 30%. Note, this is a trailing 10 tax period ratio. It is not an inception to date ratio. And these loss ratios are calculated including expenses that may not be in your session statement loss ratio. Okay, it may have other claims administration expenses involved. So if your loss ratio is maybe just under 30% on your session statement, you're like, oh, drats. You need to go back and talk to your administrator about the other claims administration expenses that need to be rolled in for the IRS test. If you failed this, and you're a listed transaction, unfortunately, you must meet strict new filing requirements that are embodied in these regs. And Tara's going to tell you about that a little later, okay? And as an aside, and several of us in the industry have talked about this, you may have some trouble getting an accounting firm that wants to be doing your filings for you. Because one of the questions is, as an accounting firm talking to your malpractice insurance, is, do you deal with listed transactions? And then they watch their own insurance rates change. All right, so nonetheless, you want to get ahead of this and talk with your provider. But if you pass the test and you're smiling at this point, wait for it. We're going to go to the next slide. And yes, another test. All right, this is sort of the last test. Okay, so you may be seeing light at the end of the tunnel at this point. Okay, but don't get excited just yet. Okay, now, and hearkening back to the time since I was born in the last century, is also known for me is the Danger Will Robinson test with the robot flapping his arms on the old 1960s Lost in Space television series. Okay, it's because this is a precursor of being a listed transaction. It is a warning shot across the bow, okay, that you might have time to not turn into a listed transaction when you hit 10 years. And you may have time to fix it. All right, now this is the third and final escape hatch from the regulations. So to pass this test and not be a transaction of interest and escape, okay, you must not have failed the financing factor test and have a 10-year loss ratio, okay, of equal to or greater than 60%. Now, well, I had been around 10 years. Well, then they'll let you use whatever amount of time that you have been out there in existence. So then it becomes an inception to date type thing. All right, so at any rate, nonetheless, where we are now, and I think about this 60% threshold, is that we're sitting here and loss ratios have been increasing over the past few years, you know, and it's really partially due as a result of our successful retail warranty reimbursement submissions that perhaps were not anticipated in the original rate cards. And so you may find it easier to get to that 60%. All right. I remember the days, from an operational standpoint, man, you want to be at 40 or 50 or something like that. You're like, wonderful. But for today's test, you need to be above 60. All right, now look, if you failed this test, you're a transaction of interest. Well, that's sort of what you started reporting in 2016, perhaps. And you must meet slightly less stringent filing requirements, but you still have some important deadlines coming up. Tara's going to tell you about them in a second. Okay, but at any rate, if you escaped, then be happy about it, and you're done until next year. And you get to do it all over again. All right, so let's move on here. So we've got a little polling question for you. Okay, have you previously filed, or for those people in the advisor role, advised filing Form 8886 for reinsurance companies in general, or the one that you own? Or let's just see how many 8886 filers we have out here versus people that are just joining, and this is sort of new information, in which case you might be clicking D. Okay, let's just see what happens. In the meantime, Tara, Andy, the complexities of these things are really going to become apparent when we put pencil to paper, and we sit down and we do that. But I must say, and I agree with Andy, I was really impressed with the improvements in the final set of regs here. I think they listened to each of the commenters. And there's 3 of those commenters sitting here talking today, and to others in the industry. So kudos to the process at this point. All right. Well, it's sort of a mixed bag here. We do have quite a number of people that said no, that they haven't done an 8886. And then quite a number of people that joined today that are going like, wow, this is new stuff. And what is this form? So nonetheless, that gives you a little bit of, we'll call it demographic data. All right, let's move on. Let's sort of summarize what I've been yammering about here. Okay, so the seller's captive test, again, was the test that many people are hoping to fall under. And where are we there? We're taxed under 831B, the micro captive rules. We issue or we reinsure, we insure or we reinsure contracts to insureds. And we have that requisite 20% ownership rule that we met. We have 0 enterprise risk in the captive, all right? And for those of you that have decided to mix in a little dealership risk, okay, you're not going to be a seller's captive here, all right? And we treat all of our portfolio products as insurance products and our tax returns that we file for the reinsurance company. Okay, and then finally, at least 95% of our risk is to unrelated customers. They gave us a little bit of wiggle room there so that a family member could actually buy a product when they buy a car. Our next item here was the transaction of interest. And to get there, we have to have either failed the financing factor test or have a loss ratio of less than 60%. Okay, that gets us in that first little bucket of reporting called the transaction of interest. And then we may make it into the listed transaction area. And again, that loss ratio of less than 60%, if I don't have a full 10 years, is going to be for the time period that I have been in existence. All right, now, as a listed transaction, I have to have been in existence. I use years, again, tax periods, okay? I have failed the financing factor and notice, not or, but and I have a loss ratio under 30% for the last 10 tax periods. So that's sort of what we summarized through some various graphs. Okay, Tara is going to the filing requirements for the transactions of interest and the listed transactions in case you did not escape through one of our 3 escape hatches. And Tara, much like our clock is clicking along on this presentation, I believe these folks' clocks are also ticking along on a few filing deadlines, aren't they?
Yes, thank you, Robert. I know we just had a polling question, but it is time for one more before we jump into those filing requirements that Robert was discussing. So if you will take a minute to answer the question on your slide, again, based on the information shared today and the flowcharts that Robert just went through, what classification do you believe your reinsurance company will fall into? Obviously, not everybody on this call is an owner of a reinsurance company, so pick your favorite of the 3 buckets, if you will, and then we'll dive into the filing requirements. Robert mentioned that hopefully those flowcharts will be helpful for you. And as we were working through this presentation, several questions came up about, again, nuanced scenarios where it's not clear in the regs, what happens in this situation. So I would just encourage everybody on the call, if you do run into a situation where you are working through that flowchart and following the regulations and you still have questions because the guidance isn't clear, reach out to your advisor, reach out to your administrator, and have a discussion about that so that you are very clear on where your reinsurance company is going to fall. The penalties for not filing these forms, if you are eligible, is way too high to ignore. So, and it looks like a lot of folks are not sure what bucket they're going to fall in. So that's great to know. You all have some homework to do after this. All right, so let's talk about the filing requirements. And forgive me, I'm a little under the weather, so if I go off camera, it's just because I need to sneeze. I don't know about where you guys are from, but the sickness is running pretty rampant around here. But I appreciate everybody's patience as I try to work through all of this. So we're going to first talk through the filing requirements for listed transactions. Then, again, we're in a situation here where you have not met the seller's captive exception, and we'll talk about TOIs separately. The filing requirements are very similar between the two, but there is a distinct difference that we will get to. So if you are identified as a listed transaction, participants of those transactions must file Form 8886 for each year that they participate in that reportable transaction. The form will get attached to both the reinsurance company tax return and the related dealership tax return every year in which they participate going forward. So again, you may have been doing this previously. Now it is absolutely a requirement to continue doing so. Additionally, Form 8886 must be filed with OTSA. You may have no idea what OTSA is. It is the Office of Tax Shelter Analysis. And the filing with OTSA is required in the first year in which a transaction becomes listed. We'll talk about that a little further, but I wanted to note quickly that the final regulations did provide a safe harbor for owners of the insured. So think owners of the dealership. That safe harbor allows them to not have to disclose participation, i.e. no Form 8886 would be required in the owner's tax return if they receive acknowledgement from the insured that they have complied with the filing requirements. There is no specific mention of owners of the reinsurance company in the regulations, so our interpretation at this time is that those individuals would not need to file Form 8886. The safe harbor acknowledgement can simply be a copy of the Form 8886 that's filed with the reinsurance company and the dealership, and confirmation that that form was indeed filed. It's not going to be helpful if you have a copy of it, but it wasn't actually filed. Excuse me. So just in summary, no Form 8886 for owners who are participating in listed transactions as long as the reinsurance company and dealership are in compliance and provide confirmation accordingly. Now, this is where it gets fun. And for the administrators and service providers on the phone, I'm sorry, because you got a lot of work ahead of you. You must apply these newly finalized regulations to all open tax years. This means that you might be collecting data going all the way back to 2012 if you don't meet the seller's captive exception and have to test for the listed transaction and TOI rules. If you are deemed to have participated in a listed transaction for an open tax year, so again, where we're sitting right now, that tax year might be 2021, 2022, and 2023 would be your open years. you must file Form 8886 with OTSA within 90 days of these regulations being published, which is April 14th of this year, so you don't have to do the math. Now, this OTSA filing is only required once per transaction. So if you participated in a listed transaction for more than one of those open years, you should ensure a filing with OTSA is made for that first open year of participation, and we would recommend that you list all years in which you participated. Now, this may be a heavy lift for administrators, and with a 90-day clock ticking, we certainly recommend that you get to work quickly to identify which companies may fall into this category. Because obviously, if you're having to do loss ratio calculations for a number of companies, going all the way back to a 10-year period in which these have been open, will take a little bit of time. Many companies may not have been in existence for 10 years, which is an advantage, but if so, you would still need to comply with the listed or the TOI rules as Robert indicated in that flowchart. One other thing to note here, you don't need to file any amended returns. So your reinsurance company return, your dealership return, you don't need to file amended returns to apply this portion of the regulations. However, if you have to amend your reinsurance company or dealership tax return for any other reason for one of those open tax years, we would recommend attaching a copy of the Form 8886 that you're going to file with OTSA to that amended return. So to summarize, for listed transactions, you're going to file Form 8886 with your reinsurance and dealership returns every year in which you participate going forward. And then everyone has to file with OTSA again. As a listed transaction, you have 90 days to make that filing if you participated in a listed transaction in a prior open year. But if 2024 is your first year participating in the listed transaction, then you would simply file with OTSA at the same time in which the 2024 tax return is filed. The required information that must be documented on Form 8886 is similar to the requirements under Notice 2016-66. The finalized regulations here specify that you include all types of policies issued, amounts treated as premiums, the name and contact information for each actuary or underwriter who assisted in the transaction, total claims paid, and the names and percentages of interest of owners. All right, so I know that was a lot. But you're going to get another look at it in the next slide because it's pretty much the same thing with one exception. So we're going to switch over here to the transaction of interest filing requirements. You will note, again, these are very similar. The exception is really kind of at the end when we talk about those prior open tax years. So just a quick recap of what you saw on the previous slide. Participants in a transaction of interest are required to file Form 8886 each year in which they participate in that transaction going forward. The form is going to get attached to both the reinsurance company tax return and the related dealership tax return. And additionally, Form 8886 must be filed with OTSA in the first year in which the transaction becomes a transaction of interest. The regulations again here provide a safe harbor for owners of the insured where they are not required to disclose participation in the transaction as long as they receive acknowledgement from the insured that they have complied. So again, just make sure that you are documenting that confirmation. So here is where things are slightly different. You must still apply the newly finalized regulations to all open tax years. So this means you, again, might be collecting data going all the way back to 2012 if you don't meet the seller's captive exception, and you must test for transaction of interest and listed transaction rules. We've already covered that. But the difference here is that if you are deemed to have participated in a TOI, transaction of interest, for any open tax year, you must file Form 8886 with OTSA within 90 days of the regulations being published, unless you previously filed during the open tax year under Notice 2016-66. So again, an OTSA filing is only required once per transaction. So if you participated in a transaction of interest for more than one open year, you should ensure a filing with OTSA is made for that first open year, again, unless you've already filed it, and we'd recommend that you list all years in which you participated. So I'm going to give you a quick summary because I know that was kind of a lot and maybe confusing. Robert and I have gone through this time and time again just to try to make sure we understand it and make it as clear as possible. The Form 8886 must be filed with your reinsurance and dealership tax returns every year in which you participate going forward. As far as the OTSA filing goes, everyone has to file with OTSA again. If you participated in a transaction of interest in a prior open tax year and did not previously file with OTSA under Notice 2016-66, you have 90 days to file with OTSA. You're on the clock, just like you are for a listed transaction. However, if you participated in a transaction of interest in a prior open tax year and did previously file with OTSA under Notice 2016-66, you are still required to file with OTSA since the regs have come out, but you can do so with your 2024 tax return and you don't have that 90-day burden. Likewise, if 2024 is your first year participating in a TOI, just like I said, if it was your first year participating in a listed transaction, then you would file with OTSA at the same time the tax return is filed. Hopefully that was clear as mud for everyone. Again, I would encourage you to have conversations with your administrator, with your tax preparer, if you have identified or have been classified as a transaction of interest or a listed transaction, because you do not want to miss these filing requirements and put yourself at risk for penalties. Okay. One more content slide, and then we'll shift over. I have seen a couple questions coming through, but please make note if you have questions about anything that we've discussed. We're getting ready to shift into that section of the webinar and would welcome the opportunity to talk through any questions you may have. Okay, so this last slide really covers, what type of documentation do we need to keep that supports our position in applying these regulations to our reinsurance companies. Our recommendation is to consider each step in the flowcharts that Robert went through earlier. And if you use one of those steps as, I think the word was, escape hatch, make sure you can prove it. This will really apply to everyone who's involved in this space. So dealers, administrators, reinsurance company, tax preparers, everyone should be documenting accordingly so that you are not putting yourself at greater risk down the road. This list that's here on this slide deck is certainly not exhaustive, but a few items we would recommend collecting include a copy of your administrator agreement, sample policies, session statements, a list of contracts for the company, and again, identifying any sales to related parties so you can assist with that testing requirement that says 95% of your sales are to unrelated customers. Confirmation of any loans or guarantees. As Robert mentioned before, both will trigger that, could trigger that financing factor. And while administrators will likely know about any loans, they may not be aware of a guarantee in place without confirmation from the owner. And then finally, of course, on the loss ratios, as Robert discussed earlier, those will need to be calculated for transactions that don't meet the seller's captive exception. It will be important to document those, including those additional claims admin expenses that are included in the calculation for purposes of the regs. So please make sure that you're documenting those sufficiently, because again, no matter where you land, if you meet the seller's captive exception, if you are a listed transaction, if you are a TOI, you want to be able to prove and understand why so that you can also document the proper filing requirements that are needed. All right, that is all I've got. Glad I made it through without sneezing. I'm going to go ahead and shift to our final polling question, but we would certainly ask that you add any questions that you have in the box, and Robert and Andy, I'll open it to you to maybe cover anything additional that we have not discussed at this point that you think might be relevant to the attendees.
Tara, I think let's see here, that last slide about documentation, I think what you and I discussed earlier was, pretty much each one of those boxes on those charts, if you're utilizing that to prove a point and take a path one way or another, then that's going to be the key piece of information that you need to prove, especially if you're headed towards a non-reporting position. Nonetheless, I think that really needs to be remembered, as we go along. Andy, did you think of stuff?
I can weigh in on that too. I just, let me be seen. Well, some people will think it's an improvement. Anyway, I think that to bear in mind that if there is an examination, one thing the IRS is usually impressed by is volume. And there will be things that could be voluminous. They want to know that there's unrelated customers. You probably have some kind of printout of contracts in force, some list that will show all the names, multiple pages for multiple years, and give them a stack to look at of the proof. And that's going to be different than what they would see with some kind of less legitimate type of program. Same thing with claims. There probably will be records of claims being paid, and not only say, well, we got a few thousand of them. Do you want us to give you all of them, or would just a sampling do? Things like that. These are things that are actually easy to maintain. And what I'm doing is telling clients, let's look at what is the easiest thing to do. It won't be the same thing for everybody. It should, to do it and make it easy on yourself. Don't create some new system. These things, they've made the elements pretty simple for the seller's captive.
Great. Well, I think we'll go ahead and hop into some of the questions. I guess Robert and Andy, maybe I'll work through them and then you guys can chime in appropriately. I'm just going to go to the bottom of the list here to start with the first question that came through. If the reinsurance position can escape in the first two escape hatches, but they have a loan, are they still okay not to file the 8886?
So that, make sure I'm unmuted here. I think I am. And so that first piece here, in other words, gee whiz, can I go through the seller's captive loop or the original captive loop? Let's just say, for example, I've got all AO product, okay, but I've got a loan out here, or I met the seller's captive test and I had a loan, and we've discussed this, Andy, I think from time to time. And I believe that the way that the regs are structured is that, if I escape through the seller's captive, or I'm just outside the scope at the very top slide there, that, the loan, we hadn't even gotten to that part of the testing yet. So then the answer is, I can have that loan out there.
I agree. The one thing to add, though, as a footnote is just because you're out of the issues under this new reg, that does not mean that there aren't potential issues with a given loan transaction, and that still you are well advised to have that loan written properly, commercially reasonable, and properly being paid. So those will cause consequences independent of the regulation. So yes, you will be out of the this listed transaction of interest loop. You will not be out of the woods for possible examination. So the loans are an issue. They just aren't but they will not trigger inclusion in the new reg if you're a seller's captive.
Yeah, I agree with you, Andy. I mean, we see loans from time to time that are non-performing, even though it's with a related party, that are merely just rolled into a new loan. No payments were made according to the loan documents, et cetera, and that's just asking for trouble. You get very good, reputable administrators out there, many of which are on this call. And, they make sure that the loan that is drafted out there is performing. Otherwise, they'll turn around and dividend that loan out, which is exactly what the service would do.
All right, we'll shift to another question here. I thought under the consumer exception, we were not needing the dealers to report the 8886. And I'm assuming that is like the dealership, the related dealership operating entity. And I was just looking back through the regs, but I believe it's in the definition of participant, which is where the dealers get included. Robert or Andy, do you want to opine there?
I was trying to find out which question it was so I could actually read it there, Tara.
It's number 15.
Oh, okay.
Yeah, participants include, but are not limited to, any owner, insured, captive, or intermediary with respect to the transaction whose tax return reflects tax consequences or a tax strategy identified. I've been like reading from the regs, but Andy, Robert, any other thoughts there?
Isn't the answer simply that if you're in the consumer coverage exception, you're outside the reg, so there's no form 8886. Isn't it just
correct?
I think that's the answer.
Yeah, maybe there's clarification that 8886 requirement for dealers is only if you are identified as a listed transaction or TOI.
Exactly. Yeah, I agree with that.
Okay.
Pick another one,
so
Tara.
question,
What do you see?
Yeah. Does the revised consumer coverage exception in the final regs essentially exempt an intermediary participant from the reporting requirements?
once you hit that, yeah,
Because
exactly.
the
That's where I
arrangement
would
is
add.
outside.
Yep. Very similar to the question that
Now
we
the
just had.
intermediary could be doing something else that could trigger it, but that's a different problem.
And I'm going to take one here that, with reference to dealerships, what are some of the less obvious enterprise risk coverages, that maybe people need to think about, and this is going to be, I think the one that I used as an example in my portion of the presentation, whereby some of these companies have decided to insure the dealership against their own chargeback liabilities from selling the products that were then shorted out by customers, is, we'll say, a less obvious one that might need to be considered. Obviously, the traditional ones were mentioned, in terms of having the dealership out there as an insured, whether it be garage liability, workman's comp, that type of thing. But I do like that one example that I just gave as one that I heard about it and I go, yeah, that is going to be enterprise risk, so I like to use that one as an example.
Perfect. Do you know if there is an extension?
Go ahead.
Oh, yeah, I was about to jump into that same one. Is there an extension available on the 90-day reporting requirement for TOIs and listed transactions? Not that I have seen. Andy, I don't know if you've heard any.
I've heard it. I didn't see anything.
No, I don't think there is.
Noted. Here's a good question. If you filed Form 8886 in prior years as a transaction of interest, but now deemed listed transaction under the final regulations, will you need to file a new 8886 with OTSA for those prior periods? So this is how I would look at it. You're applying the regulations that are in place now to those open periods. So if you filed as a TOI, but really you would have been a listed transaction under the finalized regulations, you do need to go back and file an 8886 with OTSA. If you apply those finalized regulations and you were a TOI in those open periods and you did previously file, I think you were fine as far as that prior period coverage goes, but you would need to file in 2024 as a listed transaction. Robert,
yeah,
or
and
any other thoughts?
the time clock's ticking on that one. That 90-day April 14th or whatever. I mean, the time clock's ticking on that. Because now you've determined that in 2024 you were a listed transaction. So that's the short deadline. Okay.
Yep. And then to confirm, if the dealership files an 8886 with its tax return, the owners do not have to also include another 8886 with their 1040s. Yes, as long as you get a copy of the 8886 and confirmation that it was filed.
Yeah.
And
so
again,
what does that look like?
Yeah.
That's a copy of the form that supposedly is being filed or was filed. And then the regulations don't speak to where this confirmation of filing comes from. So does it come from the company itself, or the dealership in terms of the filing? Does it come from the preparer of that tax return, that they hit the button, on filing that return? It doesn't get into that level of detail. Okay, it just says, make sure you got something in your files indicating it got filed.
If a reinsurance company is no longer selling new products and is in earnout mode, is there still a filing requirement?
I think you're still a participant in the transaction.
Yep, agreed. I think you still have to work through the flow chart to identify where you fall.
I think you're still doing the same thing.
And then another maybe compliance question, if you are a CPA trying to determine whether or not to include an 8886 with the client's tax return, what is the best way to obtain this information? A standard questionnaire that the client should send to the administrators to answer. We've had a lot of conversations about what is the next step here now that we have all digested the regs and folks in the industry have collaborated to make sure we're on the same page about the interpretation of all the rules. I think the next iteration of this, or the next part 2 of this, is what is the consistent wording that people are going to be including in the 80 and 86s that are required, and what documentation is everyone comfortable with. It might look a little different for each provider or preparer, so just make sure that you're having conversations with the folks who are managing risk of your firm and or company to ensure you're approaching that from the right way. And for our Forvis Mazars team, stay tuned, as there will be more coming from me on this.
Right. And let's consider the inherent difficulties here that the administrators are having to deal with. In the regs, it talks about when we look at the prior 10 tax periods to come up with a 10 tax period ratio, loss ratio, it also will glob on, that's a technical tax term, glob on predecessors that came about through certain transactions. Well, that predecessor might have been with a different administrator. So now that once you've got administrators talking to each other, and the first administrator lost them as a customer, so I can see them just being really anxious to want to jump in and spend their time on a former customer that the business was lost. So, I mean, just the practicalities of this have some quite apparent difficulties that are going to come to pass, I think, in certain arrangements.
Yeah, I just really would underscore that. If you're taking on new business, you now have to be looking at the record keeping for prior years, because it could trigger an obligation. And I don't think the IRS is going to be very impressed with saying we didn't bother to get the records.
Agreed. So, we're coming up on time, but there's a couple more questions that we can try to get to really quick. If the seller's captive fails the 0% enterprise risk requirement, does the intermediary still have a filing requirement, or does only the captive have a filing requirement?
I think if the seller's captive fails the 0% enterprise risk requirement, is that you're headed to the next steps of testing for LTs or TOIs. And this is, once the transaction is identified as one of those two things, that triggers filing requirements up and down the chain based upon the participant.
But if it doesn't have the financing factor, it'll still be out. So it doesn't, so just failing the 0% enterprise risk is not enough in and of itself.
Well, to make it a listed transaction, but could it still meet the TOI rules if its loss ratio
right, I
was
could
below
still be a
threshold?
TOI.
Yeah.
Yeah.
Yeah, and then I've got the same set of people that are still filing paperwork.
Great. I think we are just at about time. We certainly appreciate everybody's participation today. Let us know if you have any questions following the webinar. And again, really appreciate the time today. And thanks, Andy and Robert.